and welcome to this video all about capital employed. Now, there's two things that we're going to be doing in this video. First of all, we need to understand what the difference is between debt and equity, because if we don't know this, we're going to really struggle to understand what we mean by capital employed. And then the second part, we'll take a look at what capital employed is and how to calculate this. Let's get into it. But as we said, to start the video off, we need to understand the difference between debt and equity. Now, first of all, what do we mean by long-term debt? It's really important to know capital employed is about long-term debt, not just any debt. Now, all we mean by long-term debt, really simple. These are the loans or financial obligations that a business must repay over a period longer than 1 year. You might be thinking, well, that sounds really familiar. That sounds something like from our balance sheet. That's just our non-current liabilities. Now, what's important to note as well, your long-term debt, these non-current liabilities, they typically come with an interest rate. And these interest rates are either the cost of borrowing or the reward for saving. But in the case of long-term debt, we are looking at the cost of borrowing. Now, these can be fixed payments. We can have a fixed interest rate, or we can have a variable interest rate. So typically, the more debt we get into, the more interest that we have to pay. Now, the question becomes, what happens if a business is unable to meet its debt payments? Well, there's a couple of different things that could happen. First of all, we could increase the amount of interest rates that they charge on us. So for example, if we're a year late, they may take our interest rate from 5% up to 8%, or they can give us penalties for doing so. We can also have a damaged credit rating. So if we have a poor credit rating, it makes it more difficult for us to borrow in the future, because another organisation such as a bank may look to give the business a loan, but they can see that our credit rating score is really poor because we're always late to paying our debt. So they might go to you, nope, we're not going to be lending you any money because we want to get paid on time. As well, legal action can be taken from these creditors, the people who you owe money to, in order to recover the debt. So potentially, they could seize some of your assets as a company, so you have to pay that off. Which obviously there goes to our fourth point. We obviously seizure of assets used as collateral by lenders. So typically, when you obviously take out a loan, for example, you might sign up something as collateral. All collateral is, let's say I've got a £100,000 loan that I need to repay, but I've also got a building which is worth £100,000. So the bank may say, well, sign up that building as collateral, because if we can't collect the money, we'll just take that asset and sell it off. So we still got the money at the end of the day. Also as well, your stakeholders might lose a bit of confidence in you, because if they see as a company you're late to paying debts, you're not paying your debts on time, then they don't think the business is doing as well. They start to question the financial position of the company. And as well, the worst consequences that could happen, if you don't pay your debts on time, you risk becoming insolvent, you risk business liquidation, going bankrupt and going out of business. So that was all cheerful. That's what we mean by debt. What do we mean now by equity? Well, all we mean by equity, and this is when we raise money in finance in terms of our gearing, well, equity is the funds invested by the owners or the shareholders of your business. So debt sources of finance is when people lend you the money, they let you borrow money. But when we think of equity source of finance, well, there are two different ways of doing this in terms of getting the money from your shareholders. And this is the formula here, and you need to know this formula. Equity is just your share capital plus your retained earnings. Now, what we mean by share capital is the amount of money a business gets from issuing new shares. And that's a real fancy way of just saying selling new shares to new investors. So I might go to someone, here's 10% of my company, give me £100,000 for that. That £100,000 is share capital. And your retained earning also has another name. It can also be called your retained profit. Now, what we mean by retained profit is that at the end of the financial year, we make £100,000. Now, rather than giving that to our shareholders in the form of dividends, we want to keep that back in the business because we want to reinvest that. We want to use that to help grow the company. So that's what we mean by your retained earnings. So now we know what we mean by debt and what we mean by equity, it's time for us to take a look at the main thing of this video, which is capital employed. Now, what do we mean by capital employed? Well, capital employed is the total amount of capital a business uses to operate. And in this sense, what we mean by capital is that these are the financial resources or assets that a business uses to fund its operations and grow the company. It includes stuff like cash, equipment, buildings, or other investments contributed by owners or raised through long-term debt. When we think about capital employed, this is the total long-term investments that the business uses to help them grow and to run and develop their operations. Now, this is the important part. What is our formula for capital employed? Well, the formula that we've got for capital employed is that it's equal to your non-current liabilities plus your equity. So that is why earlier in this video, we took a look at what we mean by long-term debt and non-current liabilities from our balance sheet, and what we mean by equity, once again from our balance sheet. Now, if you're still struggling to understand what this means, what we mean by non-current liabilities and equity, go back and watch the video on balance sheets. The reason why you will struggle with this topic is because you don't know what a balance sheet is. Now, some of you might be looking at me and saying, well, my teacher told me there's another formula for capital employed. Now, I would say this is the main one, but yes, there is a different formula. Because, once again, going back to the balance sheet, why is it called a balance sheet? Well, that's because your total assets are equal to your total liabilities plus your equity. Now, if we expanded that out a little bit, remember your total assets, all we mean by this is that it's equal to your current assets plus your non-current assets. When we think about your total liabilities, well, that's just equal to your current liabilities plus your non-current liabilities. Now, remember, we said your capital employed is equal to your non-current liabilities plus your equity. So all I want to do is I want to rearrange this formula around, because your non-current liabilities plus your equity is also equal to your current assets plus your non-current assets minus your current liabilities. So we can also write your capital employed formula like this. We can also write it as it's equal to your total assets minus your current liabilities. Now, what I would personally recommend is the main formula, that your capital employed is equal to your non-current liabilities plus your equity. Now, let's take a look at an example of how we calculate this. On the screen here, we have got our balance sheet. We've got your assets, your current assets are £80,000, non-current assets are £200,000. Your liabilities, now we've got current liabilities of £75,000, your non-current liabilities of £150,000, and we've got your equity, we've got two, remember, share capital 25k and retained profit of 30k. Now remember, all our formula is for capital employed is equal to your non-current liabilities plus your equity. So it's a really simple calculation. You take your non-current liabilities of 150,000 plus your equity of 25,000 plus 30,000, which gives you a capital employed of £205,000. Now, yes, you could also do it in terms of your total assets minus your current liabilities. Total assets are equal to £280,000 minus your current liabilities of £75,000. It would still give you a capital employed of £205,000. I hope this video has helped you understand what we mean by capital employed. Thank you so much for watching, and I'll see you in the next one.